Okay. Good morning, everybody. I'm just going to wait just a couple minutes as people start to populate here. Um, Hope everybody's good on this Wednesday morning. All right, people are still jumping in. So I'm going to start things off so we can maximize our time here. But good morning and welcome to this is now our third quarterly investor briefing. Those of you been on before know that these are set up to be first thing in the morning, 8 a.m., 30 minutes. We're going to try real hard to stick to that 30 minutes. Sometimes we'll give a brief overview of some of the things coming up for MichAuto, but what we have coming up right now are the holidays. So we're going to jump right in it with our guests. And first want to thank BCG for being a great investor in MichAuto and a partner and providing us with a lot of help on a lot of different things. But this morning, we asked Jonathan Nipper and Nathan Niese, who are both managing directors and partners at BCG, really to kind of take us through what's going on with what we see coming from the new administration in DC. Also give you a little bit of dose of what's the latest with EVs. It's very fluid, as everybody knows. And two housekeeping things. One, we will send this recording to all of you along with your PowerPoint deck, so you all will receive that. And secondly, because we have a lot of information, we won't have a lot of time at the end for Q&A, but we did try to leave a little time. So if you have a question, put it in the chat, and I will try to pull it if we have time. But we will also make sure that the gentleman get back to you and follow up with you if you have a very specific question we don't get to. So with that, Jonathan and Nathan, thank you very much, and I'll turn it over to you, Jonathan.
Great. Thank you, Glenn, and good morning, everyone. Thank you for joining the session today. Looking forward to this one. This is a topic that we're passionate about and have been working closely on. I'm Jonathan Nipper, a managing director and partner with BCG, based here locally in our Detroit office. And I spend all my time in the auto and mobility space working across the value chain, across OEM suppliers, PE firms investing in the space, and others. And many know us as a strategy and management consulting firm, which is the core of our work. And as part of that, we not only have a large group and team serving the auto sector, such as myself and Nathan Niese. The auto sector is one of our largest sectors globally at BCG, and we have hundreds of experts and people across the globe. But we also, as it relates to this topic, the election and impacts of that, we have a whole practice area at BCG dedicated towards what we call global advantage, and really thinking about how our elections, policy moves, tariffs, et cetera, are going to change the landscape of the industry. And so we've been spending a lot of time on this, and look forward to sharing some thoughts with you all and getting your questions. And what I will say is, not just in the US, but this whole year, this has been a huge topic. We called it the super year for elections. There were elections across so many large countries across the globe, and the most recent US election being a really important one for all of us here in terms of the implications. And today we'll focus on a lot of the implications for EVs, but of course it has broader implications on the industry as well. So I'll hit on a couple high level points here and the themes we're seeing, and then we'll jump into some details. But as it relates to the election, even prior to the election, the EV mood had already turned more cautious and what we would say is realistic. We were having people talk about this EV slowdown, quote unquote, and all the headlines even before the election. And a lot of that was driven by some of the challenges of inflation, the increasing prices. We saw battery prices for the longest time coming down, and that trend kind of stopped with inflation, and some of the supply chain challenges. And there were also just changes in the level of consumer interest and adoption that we saw, to some degree underlying that as well, and also in the fleet segment. And so there was already, some slowing. And with this new administration being elected and taking office in January, we do see, of course, that the US is likely down a path where the EV transition slows even further. But there were a lot of the headlines that even before the election were somewhat misleading, calling it the EV slowdown. And when you looked at the data, there was still growth. It's just that the growth had slowed. And we do still see room for continued EV growth even under this administration. We just see it as a likely slower path. And a lot of that is because there are many federal rules and incentives that we think will be under sharp scrutiny and likely will change. And I'll get to that in more detail on the next page. And of course, these incentives change the total cost of ownership for consumers and do drive, some adoption. But that's not the only thing that is driving adoption, and there are still some other things in place that will continue to drive EV sales. We do believe manufacturing incentives are likely to remain in place, just given that there is a continued focus on supply chain localization, and that is a less partisan issue, or at least a more aligned issue. And we do expect selective U.S. states to backfill with supportive policies or continue their supportive policies, which we think will, continue to have, some degree of and setting in a way a floor on the EV transition. We'll talk more about that on the next page as well. And there are some, still compelling fundamental drivers in the move to xEVs. There has been a development of a lot of vehicle programs still that are yet to launch, or vehicles that have just recently launched that are, great options, for consumers. But all of this together, I think, continues to raise, major choices and in some cases existential choices on, how do you maintain competitive advantage as this landscape evolves. So we'll talk today about some of the questions that are important for everyone to be thinking about here. So if we flip to the next page, this outlines some of the different, kind of types of regulations that we see as likely changes, and then changes that are less likely but on the table, and it sort of remains to be seen how those will play out. And I'll cover each row here. So on tailpipe emissions, this is, I think, one of the really critical drivers of the EV push among OEMs. And even before this election, earlier this year, there were already changes to the tailpipe emission standards to make them a little less challenging in the near term, although the overall trajectory remained the same. And in the out years, 27 plus, saw quite steep increases in the emission standards. And these emission standards drive, huge impact on, value, because there are significant penalties. And there are several different types between, EPA, CAFE, and then the CARB, the parallel regulations for the CARB states across California and others. And net, we've looked at this a little bit, and I think there have been some public statements about this, but those emission standards were driving, anywhere from $2,000 to $4,000 per passenger vehicle of, cost or value, depending on how you want to look at it for an EV. But we do see as that this is a place where, the next administration can and likely will make significant changes. The year-over-year trajectory of the emissions, for 27 to 32 is, 7% set currently. We think that will be tempered, quite a bit. I think the bigger question is what's going to happen with the state level authorizations. CARB, I mentioned before, the California and Section 177 states, they have their own regulations, like I mentioned, and cover about, I think it's 40% or so of vehicle sales across the US. And there is a, in the prior administration, this was challenged, but it didn't, actually, go through, and the Supreme Court, did not allow for those changes. There could be another challenge here, and obviously the composition of the court is different. I think all that said, we do think this is still less likely that there will be a change because there is more involved, to actually play that through. The consumer tax credits, so the $7,500 for new vehicles, $4,000 for used, and the buyer incentives, we do think that these will likely be cut and or access severely tightened at the passenger vehicle level, and that obviously will have big implications on purchases. Although not all vehicles, in a meaningful portion, did not qualify for those, due to some of the existing constraints. But we think that elimination will cause some slowing. I think we'll probably see that particularly in the new year as consumers, may pull forward some EV demand to try to access those credits, late this year and early next year. And so I think the beginning of the year we may see some pullback on that. We do think that medium and heavy duty commercial vehicle tax credits are probably less likely to be changed or tampered with. On the production and investment tax credits, there is significant dollars for EV charging, battery systems, etc. And we think there will be some tightened eligibility, for those credits, most likely. But we think some of the production credits for battery supply chains will likely remain in place. And again, this is because those are sort of incentives for reshoring of supply chains, which we think is, a fairly supported, topic across. Tariffs, there's been a lot of talk and press about this. And I think this is a topic that has actually, been supported by the current administration as well. And we saw the increase in tariffs, just a little bit earlier this year on imports from China, and that we think will continue and potentially increase even further. And we see that as a likely outcome. And I'm sure many of you have seen the headlines about, Trump's comment about tariffing all goods from, Mexico and the NAFTA, kind of USMCA region as well. And that I think is more of a question around what's going to happen there. The NAFTA renegotiation process is starting coming up, and in the prior version of when Trump was in the office, we saw a similar pattern of very bold claims of large tariffs, and it was largely used as kind of a negotiating stance. And when we got into the actual process of negotiating, USMCA the last time around, the ultimate rules that ended up were very different from the original, bluster and statements made about what's going to happen. And so I think I think we'll see a lot of change between, the headlines and statements being made now and what actually gets implemented and put in place. But there are some big open questions on what happens there. And obviously, if there were across the board tariffs, it would have major implications on supply chains. And there are some other programs as well, loan program office activities that we likely will see some changes on funding. So this is the landscape. Some areas that I think are more likely and some that still have some questions on the table. But even if you just look at the likely changes and those being made, and let's say none of the rest of the stuff happens, that will drive significant changes, in the landscape in and of itself.
If I could jump in, just two things to call out is one, it's important to differentiate between what's executive versus legislative. Right? So legislative would be the Inflation Reduction Act, would be the Infrastructure Act, and some of the aspects that sit on the page here will require legislative approval, versus things like tailpipe emissions sit within the executive branch, and or the access related to some of the IRA credits are defined within the Treasury and the IRS. And so those can get put in motion faster. And thus the question becomes around, are we talking about day one activities, day 100 activities, or year one activities? It's an important lens to think about how these will flow through and how they get cascaded alongside some of the other things that are happening and expected to happen within Congress next year, like a giant tax package. Back to you, Jonathan.
Thank you, Nate. So as we think about looking ahead, this does raise several open policy questions And I think it's important to really consider all of these as you think about, your own strategies and implications on the business. And, I think thinking with a scenario mindset is important in something like this where there is so much uncertainty. But the couple big ones we think that it's important all players are thinking about. Number one, I mean, some of the statements about tariffs have been kind of indicating that it might be across the board. And, if the tariffs do apply to ICE vehicles and components, that obviously has implications on, how much change there will be to EV and the dynamic between EV and ICE. That remains to be seen on how that evolves. I think the foreign direct investment question is a big one, especially as it relates to China. We've seen China make huge inroads, in Mexico already. And I think so far there's been a lot of pressure, specifically with the ICTS, rules that have been, contemplated around limiting, foreign direct in the U.S. and trying to limit foreign direct investment. But we do think there may be, a slightly more friendly, view on that in the next administration. But I think some open questions on that. PHEVs have been recently treated, very favorably by, EPA and some of the rulings in 2024, and open question on how that gets treated in this next administration. But we have seen some growth in that space as a result. AVs, we expect more openness around AV and the regulations there, and having some, tailwinds around that. But we also saw some recent moves. I mean, the GM announcement recently about Cruise, drawing some questions on how many players are actually going to be able to pursue that space. And then permitting reforms. I know we saw, fossil fuels as a place that may have some easing on permitting. Will that also apply to battery supply chains, which could help lower costs and improve access here in the U.S.? So there are many more, but those are important ones we think y'all should be thinking about. So I'll hand it over to Nathan to run through a couple additional pages here.
Yeah, from here we wanted to deep dive on some of the topics that Jonathan raised. The first being a tariff. We work very closely with our trade team within BCG, conducting a series of different scenarios. And if we pull this one together, is based on what was outlined on the campaign trail about a blanket tariff on all imports of 60% on China, 10% on rest of the world. And how would that impact the US cost stack, which you'll see on the left-hand side? It can add anywhere from 5 to 6% if it's that scenario that I just outlined, or if there's what we'll call preventing the backdoor action by having a tariff on Mexico for any Chinese supplied parts or foreign supplied parts that come through Mexico. It could even be above 10% in terms of the added cost stack for the US. What's interesting then is, while that would certainly add to the US cost stack, it could actually have then even more impactful repercussions on the countries where these tariffs are targeted. So that would, with the right-hand side is where you see the revenue impact for places like Mexico, China, Japan, and Canada, among others, that when we consider different price elasticities, how the sourcing mixes would change and such things, there would be a meaningful impact on other countries as well. And therefore, depending on which lens you take here, you could say it is worth having the added cost on the US to be able to achieve the purposes of what the tariff is looking for, and to allow for localization again of some of these major components. All still to be seen. And then, as Jonathan outlined, there's other, perhaps even more critical, like the ITCS policies that are in place that would make it more difficult for certain countries to participate in the US vehicle market. Next page briefly is just highlighting again the importance of CARB versus non-CARB states. Those highlighted in green are those following the California Air Resources Boards. It represents nearly a third of the population, a significant portion of EV adoption, both on new and used vehicles as we've studied it. So these are really the engines for growth for the EV market in North America. And we would expect, again, to see relaxation on the federal side. Therefore, sort of a two-part system that could exist if authorization continues to exist for these states. two distinct markets here. And so that would be something to continue to watch unless the authorization is no longer granted to those states. And there'd be a snapback then to the lower federal regulations. And then even sub questions underneath that we continue to look at is, well, what's the role for something like a PHEV in those non-carb states to be able to meet what would be relaxed federal regulations? Up to this point, as we were looking at EPA, CAFE standards, there was importance to have hybrids, plug-in hybrids, and full battery electrics in the mix. But given what could be slower and less stringent emissions in those non-carb states, you may have a smaller but portion of battery electric vehicles that could be sold, and then hybrids and your continued ICE vehicles, where a PHEV and how it gets counted may or may not actually be necessary, and thus what's the potential pool and volumes that we could see of those types of sales now becomes a second level question. And then one thing we also have, I'd say, concerns or interest in understanding how it's going to play out is, how does the US remain competitive if the EV market scales back and continues to fall further and further behind some of the other markets that are accelerating, and China being the most obvious and clear one here, with what they've been able to accomplish over the last number of years, where EVs, full battery electric and plug-in hybrids sales are topping 50% on average per week for a number of weeks the second half of the year. They're certainly building a very large market, and therefore they will have the volume. They will have certain automakers that are larger than the entire US market in terms of annual sales, like a BYD, and are building out supply chains that is something that the US will need to emulate and have exist within the USMCA region to continue to be competitive, not just serving a home market, but serving a global market, if that remains the aspirations of both the legacy players as well as any new entrants from here. And that learning curve, how it how we catch up, or if there's a leapfrog opportunity, it remains something to continue to understand how that will play out, not just in this administration, but have repercussions well beyond what the incoming administration will see play forward. We put that in the context then of, if US players want to continue to access the full 85 million vehicle market, there's going to have to be regional strategies that are put in place. We've outlined a little bit of the US story with the flatter overall growth, being less regulatory driven, but localization of the supply chain still being very important. Europe has different factors in place, including a stronger threat of newer entrants, including those from Asia and the Middle East, and then have their own set of regulations that are kicking into a higher gear next year related to tailpipe emissions that, as we squint at it, will be a challenge given the supply and demand, or the demand interest for EVs at this current time in some of the major economies, and broader macro and microeconomic trends, such as what's happening in Germany, versus China continues to race ahead. And it'll be much more in China around hyper competition, managing that overcapacity, and determining when, if, how, and for those players to continue to expand internationally. The call out at the bottom is something I just also want to emphasize is our forecast, many other forecasts over the prior years were all pointing towards what is relatively a common North Star of EV transition that would largely accelerate once you got to 2030. By 2035 or 2040, you start to see a fairly major wind down within the three major regions. Now that there's different competitive dynamics in place, a different floor set by regulations, they're going to be not necessarily traveling at the same speed or slightly off speeds, and in different directions. Is how to manage those factors and dynamics across the different regions will be incredibly challenging, and more challenging to manage than might have been previously expected. And so we end here with just, what's the so what for those of you that are on the phone, for automakers, for suppliers, for others in the ecosystem. We think that there's a whole series of opportunities to rethink about the balance sheet, rebalance the portfolios. A restructuring could be important for either the whole company or for certain regions or product categories to best fit with this new direction. Thus, there's a need to rewrite those strategic and operating plans, think about footprints, supply chains. Scale continues to be a really, really important topic that we're helping our clients with around how do I lower that break point on for pricing, for costs, and give myself improved flexibility to try to create scale where it otherwise isn't, because an average program size may be smaller or more uncertain relative to its ICE counterparts. And then there's a whole series of things about rethinking collaboration and aligning with other players in the ecosystem on tech and software, with regulators that we see incredibly important to be able to navigate this together and to share that risk versus taking it solely on by one party. If else doing so just increases the likelihood of not finding success. And then I'll highlight the last piece, and we can move on to questions from there, I believe, is that continued importance about rewiring business models. What some of the new entrant OEMs, particularly out of China, have proven is the speed at which they're able to develop new products, react to the market. That speed and innovation is continuing to demonstrate itself as a competitive advantage driver. And while not easy to inject within the organization, we see as just essential to continue to give thought to that as we move forward into the coming years. So with that, I think that represents the end of our planned presentation, and happy to take questions. Or
Yeah, thank you
Okay.
guys. Exactly what we talked about, and appreciate that you kind of brought everything together. So where we're at right now, there is a big question mark over everything, obviously, but you guys framed it really well. In the interest of time, I got a couple questions for you. And one observation is, obviously, when you overlay the electoral college map over the non-carb states, it's virtually identical.
Yes.
Which I was not surprised to see. I hadn't looked at that non-carb state map in a while. Let me just grab this one from Arn real quick. The 6-year gap of the U.S. towards the market leaders in China you mentioned, did that statement reflect on the traditional U.S. automakers only, or did the statement include Tesla?
It was intended more to be a legacy automakers plus the supply chains associated with it, including those supply chains that Tesla and others will be leveraging.
Okay, thank you.
Those that have a stronger place within the China market, I think, can capture some of the benefits that are existing in China and then bring those over to the rest of their global portfolios.
Got it. Thanks. It's very fresh. Last 24 hours. Obviously, it's been brewing since, but either of you comment on the Honda Nissan, and you really did mention that in part of your presentation, that when you said about restructuring consolidation,
Yeah.
we're going to see more of this.
Yeah, well, and I think even before a lot of these, election and administration, we saw a lot of partnerships happening, right? There was the GM Hyundai partnership announced this summer, and I think the challenges ahead for many automakers necessitate, partnerships to reduce, capital costs, investment in this transition, and also, mitigate uncertainty around supply chain and provide optionality. While I didn't have any insider intel on the, Honda Nissan announcement, I do think it's not surprising in the sense that I think we'll see more of these coming as well as OEMs look to, mitigate risk and form additional partnerships to do so.
Again, I have so many questions, but I'll wrap on this one. Kind of a follow-up to that. Are any of the legacy traditional companies doing well or holding the ground in China? it seemed, I haven't heard any real success stories lately other than market share decline. Obviously, they still have JVs and things like that. But I know Honda is one of the ones that's taken a hit. And I know Nissan didn't have quite the presence, but I was just curious.
Yeah, happy to take your thoughts, Nathan. I wish I had a very great success story top of mind. I think if anything, to the earlier comment, Tesla's probably been the best performing in that market, given all the challenges. But even there, they've faced a lot of pressure too. Nathan, any thoughts from your side?
Yeah, it's always important to de-average ICE versus EV markets, and the EV markets have been particularly difficult outside of Tesla, but even the ICE markets, we're seeing continued erosion from nearly every player that's not Chinese badged within that market over the last, and it continues to accelerate within the last months and quarters relative to even just the last year or two.
And still,
And so it's a key topic of every boardroom,
Yeah.
I would say, from the clients that we serve, at least, as China or China market as one of the key things that they want to have an answer for as rapidly as possible.
And then on top of that, the overcapacity that market already has, and on top of that, their desire to go global.
Well, and just to build on that statement, you mentioned foreign automakers in China. The Chinese automakers in China, it shouldn't be lost, are almost everyone is struggling on profitability, with the exception of a very few like BYD. So it's there's only really a couple winners there.
Yeah. Well, listen, Nathan and Jonathan, thank you. I really appreciate you guys taking the time to do this. It's a great deck, great overview. Everybody on the call, we're going to send you that deck. Their contact information will be on one of the last slides there up front. So you have that if you want to follow up with them directly. We will send you a link to the presentation. We will send you the deck. And in the meantime, we wish everybody a happy holiday. Thanks to all the companies that support us, including BCG through the year. And we'll see you in the new year. So thanks, everybody.
Thanks all.
Thank you. Thank you all.